We'll be recording today's webinar, and let's get started. Before we get started, the disclaimer. This webinar is free of charge. You're not expected to be a client of Empower Financial or sign up for any of our services. The information provided here is not individual advice. Please consult your advisor or your CPA for any specific advice for your situation. And this webinar draws from many sources on the internet. We've tried to use the most accurate, up-to-date sources, but we cannot guarantee all the accuracy of all the information here. And lastly, any investment products, stickers, examples that we're using are for illustration purposes only. With that out, let's get started. So the agenda for today is we'll start off with introductions, and then we are where we are right now in the market, in the economy. What are some of the lessons that we have learned through the last bull market and the current impending recession? And then we'll move on to investing, both for the short term as well as long term. And finally, we'll wrap it up with opportunities, what you can do now and what to look out for in the future. Finally, we'll leave some time for Q&A. The whole presentation part should take about 40 minutes or so, and followed by Q&A. We hope to wrap up by the hour here. And you don't need to take any notes. This webinar is being recorded, and I'll share it with you. That also means that some of the slides are dense on information and text, so please forgive me. As again, my name is Praveen. I'm the principal advisor for Empower Financial. We are an advice-only financial advisory, which means that we don't manage your assets, but we offer advice, comprehensive financial advice on topics like investment advice, budgeting, cash flow, retirement planning, tax planning, estate planning, and so on and so forth. The primary motivation for this webinar really is what I've been doing with my own portfolio, as well as advising my clients, friends, family over the last few months. And as such, the focus will be on the breadth rather than the depth. So we will be going over broad strategies instead of a detailed look into how to execute some of these strategies. And this webinar assumes basic knowledge of markets, economy, and investing. And where possible, I will stop to break down some concepts or define terms that I feel will be helpful. So I know many of you are already familiar with these things, so please bear with me while I do so. Okay, so before we get into this, a very quick word on why we need to understand economy and markets as investors. I'll distinguish what is economy and then what is market. Economy is really the sum total of all the economic activity that we do: jobs, taxes, policies, agriculture, so on and so forth. And markets are really a small part of the economy. Markets are just an exchange where assets are bought and sold. And as you can tell, what happens in the economy has a huge bearing on what happens in the market. And as investors, what happens in the market directly impacts our portfolio. So in order to be a good investor, you need to have a good understanding of the economy and how it affects the markets and so on and so forth. Which is why let's spend a few minutes here on talking about the economy and where we are right now. So firstly, we are in unprecedented times. We have a lot of money supply, as defined by M2, which is essentially all the money that the public has in their savings account, money market accounts, currency, and this is at an all-time high. We are at $21.7 thousand billion dollars. That's a lot of money. And then at the same time, what has happened is there's a lot of geopolitical uncertainty with the war, China's zero COVID policy, energy shortages, a tight labor market. All this has meant the supply side of things is looking very grim. It's very tight. So we have a situation where the demand is there, but there's no supply. And this has led to a skyrocketing inflation, 8.2% as of this morning. These are levels we haven't seen since 1970s. Inflation really is a measure at the rate at which prices change, either increase, which is called inflation, or decrease, which is called deflation. And all economies need a little bit of inflation. Think of inflation as a treadmill. When it's in control, like 2%, 3%, it's good. It says that the economy is doing well, things are growing. But when you have a really high economy, things are out of control, then it's a disaster for the economy, much like a treadmill. It's not in control now. So the Fed, whose broad mandate is really to stabilize the financial markets, has to step in and do something about this acute imbalance in supply and demand. So one of the levers they have is interest rates. So they're raising the interest rates in order to cool down the economy, combat the high inflation. And right now it's at 3 or 3.25%. It's called the Fed's fund rate, which is essentially the money, the rate at which banks borrow from each other or from the Fed. And this is slated to go up to close to 5% actually in 2023. So the Fed is doing quite a bit to curb this inflation. And all of this happening in the economy is showing in the stock market. The stock market right now is 25% down, the S&P year to date. And bond markets are 15% down. And the experts all agree that we might be headed for a recession in the first part of 2023. So that's where we are with economy and the markets. And all this might sound like doom and gloom, but in reality, it's all a part of economic cycles. We still don't know how deep the recession might be or how long it will last. Just a graphic on your screens here. It shows the past bear markets. A bear market is essentially 20% or thereabouts, lows of 20% from the previous highs, right? So what we are seeing here is on the y-axis is how much the market has fallen by 20%, 40%, 60%, so on and so forth. And on the x-axis here, we are seeing how long it takes to reach that down market. And as you can see, this particular market, this picture was taken in this graphic was created in June. So we are now at 25% and about 250 days in. As you can tell, this can go pretty deep, or it can go pretty long, or both, and we just don't know yet. But it's really important to know that all these cycles, all these recessions that have happened in the past, we've come out just fine. Of course, there's different lessons we learn each time. So let's look at the lessons that we are learning this time. First lesson, there is such a thing as too much of a good thing. What this really means is that the low interest rates, the easy money that was there for the last decade, it had to stop at some point. Asset prices had gone up to unsustainable levels. So what we are seeing is a much needed correction. The second lesson is history never repeats itself, but it rhymes. This is a quote that you might see often these days. Yes, this is a normal recession and it's a part of normal economic cycles and activity, but US hasn't seen inflation like this in over 40 years. So we are entering a recession with high inflation, which means that the Fed has to increase the interest rates. And unlike past recessions where the economy was slowing and the Feds had to drop the interest rates to stimulate the economy, this time it's going to be the other way around. They have to dampen it and actually slow down and create a recession of sorts to bring the supply and demand back in equilibrium. When stocks zig, bonds don't necessarily zag. This was one of the most common advice the boomer generation got, which was put 60% of your savings into stocks, 40% into bonds, and you'll be all set when you retire. But this particular, through the pandemic and through this recession, we can see that the 60-40 portfolio is dead. And it's really time to look beyond stocks and bonds. There are a lot more asset classes now, and there are a lot more investment vehicles that an investor can and should use in their portfolios. And we'll talk more about them in the upcoming slides. The next lesson is when things change, they change quickly. We saw this once during the pandemic, March 2020. We see this again. When the slide starts, it goes down pretty fast. The same thing is true when things start looking up, it goes back up pretty quickly. So you don't want to wait to prepare your kind of weatherproof your portfolio. You're either prepared or you're not. So it's good to be prepared all the time. And how does one do it? Well, you go back to the conventional wisdom, which still stands the test of time. Broad diversification, risk-appropriate asset allocation, and conservative use of leverage are your friends. So let me take a quick moment to define those things. Diversification, most of you are familiar with, using more than stocks and bonds. And risk-appropriate asset allocation just really means that you have to understand your own risk profile, which is closely related to your age, your financial goals, your risk averseness, and a lot of other things. But your asset allocation really has to reflect your risk appetite. And leverage is just another term for debt. You need to be prudent in how you use and how much you use. Okay, moving on. Right, so that was about market and the economy. So we're here for this. What does this all mean to me and my portfolio? What can I do? So in the short term, let me first define short term. Short term, I would say, is the next 3, maybe 4 years. Again, it depends on you and your personal situation. If you're closer to retirement, or if you're saving up for your home or a major expense, then you want to pay more attention to the short term. So firstly, big sweeping changes are not recommended. Do not move entirely to cash. Do not sell big swaths of your portfolio. Make adjustments of the magnitude of maybe 2, 3, 4, 5% at most at a time, and see what happens, how the market changes. Learn more as you make these changes. We recommend staying invested at all times in the market. Don't try to time the market. And selling something just because something is down is really not. It's a negative reaction. It's not something that you want to do right now. What you could do instead is actually consider changing how you are doing your ongoing contributions. Let's assume that you are putting away $1,000 a month after your expenses, and you were putting maybe $600 in particular stock, or $300 in bonds, and $100 in crypto. Take a step back and say, okay, I don't need to do this right now in this way. Given everything that I'm learning about the market and the potential recession, how do I want to re-strategize? So that might be a better way to start going towards where you want to go, rather than make these big changes with your existing portfolio. And the third point really is, this is the most important point in this slide for the short term, and this really applies to all of us. which is build and inflation-proof your cash reserves, your emergency funds, your down payment that is coming up, what have you. Your cash is losing value as we speak to inflation. So it's important that you inflation-proof your cash reserves. And in the next slide, we'll talk about how you could do that. And when it comes to bonds, bonds are really debt instruments. And without going into too much detail, they are safe bonds, like treasury bonds, which are backed by US government. They're investment grade bonds, which essentially are credit-worthy corporations or local municipal governments. And there's junk bonds, which are not so credit-worthy, high-risk bonds. So you want to tend towards treasury or safer bonds right now. And bonds are also very sensitive to interest rates. So short-term bonds tend to be a little more, little less sensitive rather to interest rates. So prefer short-term, prefer higher safety when it comes to bonds right now. And when it comes to equities or stocks, we advocate broad passive index funds, things like S&P, large cap value, dividend paying stocks. There are indices for all this. We urge you to continue dollar cost averaging, which is just putting a sum of money every month or every so often into these. Again, no big changes. Alternatives can also be good hedge during these times, but they're not suitable for all investors. And we'll talk more about alternatives as in the upcoming slides. All right, this is a very dense slide. And I won't go into full details here. Again, remember, short term, you're talking 3 to 4 years. It's also important that the pros and cons of these various instruments are based on the current environment we're in. We're in a rising interest rate environment. So the pros and cons are based on that. Most of you are familiar with high yield savings, CDs, money markets. So I won't go into those, but I will briefly talk about I-bonds and short-term treasuries. I-bonds, you must have heard them in the news in the last year. The great thing about them is that they are backed by the full faith of US government. The interest rate, bonds is actually a misnomer. It's more like a CD. So when you put some money into I-bonds, you're actually giving the government your money, and in return, they're paying you interest rate, which matches inflation. That's the beauty about I-bonds. The other thing is the interest rate is taxed, the interest that you earn, is taxed only at redemption. Let's say you hold it for 4 years or 5 years. Years 0 through 4, you're not paying any taxes on the interest. Only in year 5, when you sell it, or if and when you sell it, that's when you realize the taxes on those interests. But there are some caveats. There's a limit on purchase. It's only $10,000 per calendar year per SSN. There's also a 1-year lockup, which means that if you put it in now for next 1 year, you cannot redeem your money. And then there's a partial penalty for 3 months. And then after 5 years, there is no penalty. But the great thing is, through all this time that you're invested, the interest rate matches inflation, which means that you're not losing the value of money due to inflation. In low interest in low inflation environments, they tend not to be great investments. But now these are good, and the current yield as we speak, or the return, is 9.62% for the first 6 months, and then it's going to be 6.48% for the next 6 terms annualized if you get in before October 31st. And you can buy directly from treasury.gov, which is the Treasury website. Moving on, short-term treasuries. Here again, these are debt instruments backed by US government. Their rates are better than high-yield savings or CDs. They have shorter lockup periods, 4 weeks to 1 year. And the interest rate obviously depends on the length. So for example, as of this morning, the interest rate on 4 weeks was 3.07, and half a year, 6 months, was about 4.16. So they're pretty good, the interest rates are. They're relatively liquid. in that there is a secondary market. Let's say you have 6-month treasury and you want to sell it in month 3. You might have to sell it at a discount, but it's not like your money is locked up until 6 months. And obviously, there's no penalty if you hold it for the entire 6 months. So these are some of the preferred instruments to make sure that your cash reserves are not losing value to inflation. And we recommend these for short-term investing right now. And moving on, long-term. Nothing really changes for the long term if you are if you have a stable income with good savings rate, or if your time horizon is more than 10 years. It's too early to tell what kind of a recession this will be, so nothing really changes as of now. But we do have to warn you that the returns might not look like the last decade. We are coming off of an extraordinary bull market where we saw double-digit growths consistently. That might not be the case for the next decade or even longer. So adjust your expectations, stay invested, continue to have a meaningful allocation in bonds and international equity. You might ask why. Bonds have had a bad year, and that's because the interest rates have gone up. But we will be in a high interest environment. We are entering one. So the bonds will be pretty attractive instruments. The expected returns for bonds have nearly gone up by 2% since last year. So holding bonds makes even more sense now. And they play a part in your well-diversified portfolio. So continue to hold bonds. The same thing with international equity. I know international equity has taken a beating in the last decade or so. The US markets have done really well compared to the international equity. But you just have to look back in time. There are many, many decades when international equity has outperformed the US market. So we urge you to continue have a meaningful allocation in both bonds as well as international equity. In the long term, this is our view of how you should be approaching your portfolio construction. This is called a core plus satellite approach. The core is about 80% of your portfolio, and the satellites make up about 20. Let me break it down for you. So the core consists of large cap US equity, small cap equity, which just means that it's the entire US market, fixed income, which is bonds, international equity. Why does this belong in core? Because they're cheap, they're well understood, they're efficient, they have a low barrier for entry. You can start investing with as little as $50. They're well understood and well regulated. So it makes sense to have a core, the bulk, in these asset classes. And the remaining 20% you can, or 20-25%, you can use to diversify. One note about satellites is that they all tend to be more expensive. They might employ more active strategies. They're higher on the risk spectrum, and therefore the reward can be high too. And many of them are illiquid. So when it comes to satellites, which satellites, how much to invest, all of these really depend on your goals and your risk appetite. We really suggest that you talk to a financial advisor when it comes to how to allocate between core satellites and which satellites. And furthermore, in satellites, we have the traditional satellites here on the right, like REITs or high yield commodities, which precious metals, emerging market equities, and so on and so on. These are all traditional satellites. And on the left here, we have sample alternatives. And we'll be talking about alternatives a little more as we go on. For example, private equity is there, private real estate, hedge funds, crypto firmly belongs there. So these are all alternative satellites that you can use to construct your portfolio. And one thing we always say is diversify into alternatives through satellites. As we had said earlier, the time of 60-40 is gone. It's time to look beyond, try to understand, try to see where they belong in a portfolio, and start thinking about how to kind of contribute to them and get some allocation into them. Let's now briefly take a look into the different alternatives. This is not an exhaustive list. And again, I won't be spending too much time in each of these, but just a brief overview. Private real estate. This is probably by far the most common one. Things like apartment buildings and office space and so on and so forth. They're all private real estate. They're owned by investment managers who are called sponsors, who put some of their money, who take money from institutions or retail investors like you and me, and they go about their plan, either develop or refurbish or whatnot, and then they sell it for a profit, and they keep some and they share with us. And so private real estate is very common. There's a lot of crowdsourced syndicated options these days. But then again, I reiterate, alternatives, this is not just private real estate, but common to all alternative investments is that they can be highly liquid, which means that the turnaround time can be anywhere between 5 and 7 years. They require strong fund managers who know what they're doing, who have an excellent track record. So it's really important that you vet the managers that are managing your money. They lack the transparency of the public counterparts, and they also have higher fees. So it's really important that you, when it comes to alternatives, that you know what you're doing, pair up with a team or an advisor, take your time in understanding, and then get into these. Moving on, private equity. This includes venture capital. Just like stocks are a share of a company in a public company, private equity is really a stock in a private company. And there are multiple ways you can get into it: venture capital, leverage buyouts, and so on and so forth. But one thing that we consistently notice is that the private equity is somewhat correlated to what happens in the public markets. There is a lag. So you might see the public markets, private markets being devalued maybe in the next 6 months. And right now, we feel like there are better opportunities in secondaries. We'll talk about that when we go to the opportunities section. Moving on, there's private credit, which is really just like bonds are credit instruments for the public. Private credit is when companies borrow to fuel their growth. For example, before Uber became public, they had to invest a lot of money. They did a lot of it through debt financing. So that is an example of private credit. Again, the quality depends on who is the investment manager, what is the collateral, what is the credit worthiness of the borrower. All these you need to understand before you get into private credit. Hedge funds. This is again a pretty popular one. Hedge funds, as the name implies, they hedge their bets. They take small but really outsized bets. For example, it could be technology in Korea, something very specific based on the research, and they put money hoping that it pays off. So what we've seen is in the long run, hedge funds have really underperformed S&P 500, but in short-term, highly volatile conditions, they can be pretty lucrative. It's not something that we easily or often recommend, but then again, for the right type of investor, then it might have a place in a portfolio. Crypto, this needs no introduction. It's been highly volatile, and the primary thesis of crypto was that it was going to be anything unlike public equity markets, but it's not true. If this year's any testimony, it's played out exactly like the public markets have. There's a lot of regulation coming into the space, and we don't know how it will change the crypto ecosystem. But what we know is that it will change. and that will define its role in our society, and therefore its utility, and what is the benefit to us, and how we should approach investing in crypto. At this time, investing a lot of your portfolio in crypto is not recommended. Again, talk to somebody who's knowledgeable, financial advisor. There's a lot of information out there. All right. So you might be saying after all this, hey, this is really great. I agree with this approach, and it'll take me months before I understand any of this and I can take any action. Is there anything I can do right now? I started the year with like 100,000 in my portfolio, and it's at 70,000. And what can I do right now? So let's move on to what you can do right now. What we saw thus far was about long term. So let's come back to the present moment. Here's something that we can do right now. Again, this is not for everybody. It might apply to you, it might not. But I do think that this is generally applicable because we have all our portfolios have taken a little bit of beating in the last year. I call these silver linings because you can do them right now and take advantage of these. The first one is Roth conversion. What is Roth conversion? To define Roth conversion, let's talk about traditional IRA or 401k is pre-tax. The money that you put there is not taxed before you put money in there. When you draw it out, the money is taxed. Roth, on the other hand, the money that you put in is taxed, and when you draw it out, it's not taxed. So this is an opportunity to convert some of your pre-tax investment into post-tax investment, which will go tax-free. For example, if you started the year with 100,000 in your traditional IRA and today it's 70,000, you'll be converting only 70,000 into Roth, and you'll be paying taxes only on the 70,000 instead of 100,000, and the 70,000 will grow tax-free into the future years. Again, there's a tax implication when you do this, so consult your CPA or your tax preparer for what to expect if you use this time to do a Roth conversion. The next thing is diversifying away from your concentrated positions. This is very common in the Valley. We all are familiar with how the bull run has affected our portfolio. It's become skewed. The Googles, the Amazon, the Facebooks have grown so much, and they've become these big holdings in our portfolios. They present what is called a concentration risk, which means that if they were to tank, they would leave a significant dent in your portfolio, and you don't want that. You want to diversify risk, and concentrated positions are not good for your overall portfolio sensitivity to the market. So this is a good time, again, using the same analogy. If your Facebook holding or your Amazon holding was 100,000 or 200,000, now it's probably 70,000. So it's a good time to convert, diversify away into broad passive index funds. And you might say, hey, I think Amazon is really a good bet. It's doing really well. You might have a strong belief in that company, but still from the overall risk approach, it's not really good that you hold a single asset in your portfolio. There are a couple of reasons. One, you might be employed with them, so your fortunes are tied to Amazon or Google in more than one ways. You're employed with them, and you have much of your portfolio in them. So you want to diversify away from this risk. So now is a good time to move away, and you can still hold some, but moving to a broad diversified index fund is a good idea. Again, when you sell them, there can be capital gains. So please consult your tax preparer or CPA for this. Tax loss harvesting. This is a fairly advanced topic, and I will not go into all details of this. But if you bought an asset for $100 and today it's $70, when you sell it, you can actually claim a loss with the IRS. And there are limits to how much you can claim and how you can claim. So you want to, again, talk to your tax person or CPA, or understand why you want to do this before doing this. These can really these tools can really help in moving your portfolio make these strategic shifts where you can move it into a direction that is kind of conducive for long-term growth and overall risk appropriate asset allocation. So these are the things that you can do today. But what about some of the opportunities in the future? Well, hiding in plain sight is U.S. stock market. The U.S. stocks are much more reasonably priced now than like in January. P/E ratio, which is really like a metric for how expensive a stock is, it's looking pretty good. It's back where it was in 2014. So it's pretty good. And we don't know how deep this recession will be or how long it will be. It could go down further, but today it's looking pretty good. International stocks, the same thing. They're very favorably priced, but they do have the headwinds of the strong dollar, which is hurting them. So again, we recommend you continue staying invested in international equity. Private equity, secondary markets. So secondary markets, remember, private equity is illiquid, but there is a secondary market, which is much smaller, where the demand and supply is not well defined. And let's say, for an example, the California retirement system needs to, it has a mandate to pay retirees pension every month or every quarter. So they have to have by their investment policy, they need to have certain amount in cash, certain amount in certain risk types. So they have, irrespective of how the market is, they need to sell. So what they do with illiquid assets is approach a secondary market buyer, and they'll sell it for a discount. So it's an opportunity for investment vehicles which primarily invest in secondary market right now. Again, this is an alternative investment. You need to be aware of what you're doing, but there is an opportunity there. And then let's move on to bonds. Yeah, in high interest rate environments, bonds do really well. Their returns are pretty good, and we are entering a high interest rate environment right now, relatively speaking, compared to the last decade. So bonds will become favorable again. Continue holding them, and you can pivot to longer term bonds as interest rates stabilize. Real estate, it's really early to tell, but there might be some opportunities in real estate in the next couple of years. Right now, we are seeing both the demand and supply shrinking, so not much has changed, but that could change. So here are some things that we want to watch for the next 12, 24 months and see if there are some opportunities. All that really brings me to the end of this presentation. I'll leave you with a couple of reminders. The first thing is, remember, market tends to be forward-looking. What this means is that the market bottoms before the economy does, and the market rebounds before the economy does. So this means that you don't want to try to time the market. You don't want to try to sell opportunistically and enter opportunistically, because as the adage goes, time in the market is always beats the timing the market. So this graphic here shows that of the 20 best trading days since 1980, 9 of them have happened in worst years, where the stock market turned negative, and the 20 worst trading days have happened in years where it turned out to be positive. So going by a short time frame, you cannot tell how the market is going to behave in the long term. So stay invested in the market, be disciplined, and continue saving and educating yourself. So that brings me to the end of the presentation. So we'll now jump into some Q&A. My contact information is up there, and if you need help or any clarification with anything we've done today, we can go over that. If you have any questions, please type them into your Zoom chat and I'll take some questions now. I cannot offer personalized advice, but I'm more than happy to answer any other questions you might have. Let's see if there are any questions that have come in already. Well, somebody asked, does comparing a pandemic and the stock market analogously make sense? Well, I don't think it's much of a comparison as much as what's happened in the pandemic has affected the stock market, because what happened in the pandemic has affected the economy. The stimulus, people saving a lot because they're not spending a lot. The money supply that we spoke about, it's because of the pandemic. Some of the policies, some of the behavior changes that we noticed during the pandemic. So that has definitely had an impact on the market. Another question rolled in. Can you explain tax loss harvesting a bit more? Sure. I think, as I said, it's an advanced topic. So let's say you bought a stock for $100. If you sell it at $150, you have to pay something called capital gains on the $50 gain that you have. If on the flip side, if it drops to $50, then you have a loss of $50. So you need to, if you sell it at $50, you can claim with the IRS saying that you encountered a loss in your investment. But there are limitations and caveats. Very quickly, you can only claim up to 3,000 of your losses per year. The rest will be carried over to next year. There's something called wash sales. You need to be careful of them. And it's only applicable in your taxable brokerage accounts. They're not applicable in your Roth IRA or a traditional IRA because those are tax advantaged accounts. And you can't sell S&P for, like, say, or any stock for Facebook, Amazon, Google. You can't sell it at a loss today and buy it tomorrow because that's considered a wash sale. And the other danger of tax loss harvesting is that you might sell, but then you might not enter the market again. So you're losing the money is not working for you. So you need to choose investments carefully and stay invested in the market. For more, I'm definitely happy to kind of chat one-on-one with you. This is a pretty advanced topic, so please make sure that you understand it well. Can you explain how secondaries work again? How do you buy these? Secondaries are funds. Secondary market. It's where the demand and supply are not very strong. They are much more bespoke deals. Going back to the example, let's say a pension fund has a mandate to stay in cash, 20% cash, and they see that they're overweight in their private equity, so they have to sell it. So they will approach a marketplace or a facilitator to say, like, I want to get rid of my position in this private company. It might be venture capital, it might be any other form. And the facilitator will find a market, find a suitable buyer, and there will be a negotiation. Because the supply and demand are not well regulated or they're not that high, the seller can, in a down market like this, the buyer gets to call the shots. So there is a discount. How do you buy them? There are platforms that you can buy, on which you can buy. Almost all of them need RIA, an investment advisor, to facilitate it for you, because there are suitability recommendations just to make sure that you are qualified and it has a place in the portfolio. Again, talking to an RIA, to educate yourself, you can use a platform called CASE. Again, it's just an educational platform. CAIS is how it's spelled. You can educate yourself there. Right. So Somebody is asking about short-term investment. What about the money that you want to keep liquid to jump on some of the opportunities? What would you recommend for that? Again, going back to the slide, you can see there are 3 or 4 listed there: high yield savings accounts, CDs, short-term treasuries, money markets. Some of these are more liquid, which means that you can just, at the click of a button, you can sell them or move money. High yield savings account, secondary, money market accounts, these are all highly liquid, so you can just sell them when you want. So you can have some in them, but there are some which are less liquid. Let's say it takes 3 months to get your money, like a short-term treasury. So you can allocate per your needs into these, in 4 or 5 investment vehicles for the short term. You don't need to put everything into one. Different vehicles have different characteristics, and you can you need to think about when you'll need the money, how quickly you'll need the money, and how much will you need before choosing which instrument to use. Bit more. Okay. Somebody is asking strategies for paying off high interest loan like HELOC, margins. I think there is there anything to evaluate for the long term beyond you can make more money investing that offsets it? Right. So high interest loans. Yes, the general recommendation is that if you're paying a lot in your debt servicing, which is essentially interest payments, you want to pay them off. Does it make sense to have a line of credit for jumping on an investment? Maybe, maybe not. It really depends on your risk appetite. Again, it's hard to give individual advice, and I don't want to on a forum like this, but it really depends on your individual circumstance. But in general, paying off high interest loans is a good idea. You could have a line of credit for some purchases coming up, depending on the terms and depending on your risk appetite. For emergency fund, what's your advice on inflation proofing it at least somewhat? Well, if you go back to slide, I don't know the number offhand, but the vehicles for short-term investing, all these are good vehicles. Again, how much you put into each of these depends on how quickly you need the money. So let's say 1 or 2 months of spending, if you lose a job, it might make sense to keep it in high yield savings. But if you are keeping, let's say, a down payment, which is not for a year or 2, then something like a money market, short-term treasury, I-bonds, those make more sense. So it really depends on how quickly you need access to money and how much. Let's see. Would you be willing to make the slide deck available? As of now, I'm going to make the webinar available, the recording of it. I'm not sure about slide deck, but I will look into that. Okay, I guess. So there's another question about arbitrage, basically taking something like a low interest loan and then putting it in something that yields higher interest. If you can get a loan for 3% and invest somewhere where you can get like 4 or 5 or 6%, does it make sense? Again, it's hard to give specific advice, but it really depends on the terms of the loan and the liquidity and the creditworthiness, the stability you have in your paycheck, and so on. So it is hard to give specific advice. That's it. I think we have. Okay, somebody's asking about cannot find the link to buy I-bonds on treasury.gov. This is very, very well documented in the last year, and you might want to Google this, something like how to buy I-bonds on treasury.gov. There are many YouTube tutorials. There are many blogs which go step by step. I'm happy to answer your questions one-on-one. But yeah, it's on treasurydirect.gov, G-O-V. That's the website for US Treasuries and all the instruments that they offer. You can buy it over there. Right. Are there any other questions? One note before you go, right after this webinar ends, there will be a survey that Zoom will pop up in your browser window. Please take a minute. It's just a short 3-minute, 3-question survey. If you can fill it out, it'll be really helpful for me to know if this is useful, what other content should I be putting out there, and what worked for you, and so on and so forth. So please take a moment to fill out the survey. One last question here. Are short-term US Treasuries by US Treasury? Yes and no. US Treasury site is not the most intuitive. Short-term treasuries are available on your brokerages as well. That is Vanguard, Fidelity, Charles Schwab, all your TD Ameritrade, all your brokerages have short-term US Treasuries, much easier to buy, much more intuitive user interface. You could buy it there too, or on treasurydirect.gov. All right, we'll stick around for a minute here if there are any other questions. Otherwise, thank you all for making time on this Thursday morning. I appreciate your time and presence. Thank you.